is Andy. I'm talking with Francis Hunt with the Market Sniper. How are you doing, Francis?
Hey, Andy, delighted to be with you. Thank you for the invitation.
Thanks for coming on board. Yes, tell me a little. We've had a lot of things going on in the markets here. Tell me a little bit about what's going on in the currencies and how that sets up the general markets, where it goes with the equities, precious metals, energy, and that sort of thing. What's going on in currencies?
Good to be checking in with you. You know, currencies, it's such a good question that you kick off there because these are the big markets. Essentially, there's been quite a bit that has suddenly seen a directional change. The Federal Reserve was the lead hawk on inflation. They did 4 0.75 hikes, you'll recall, which is, you know, 3/4 of a way to a full point back to back. And so the dollar was getting quite a bit of implicit support in that, although it may not have felt like that initially. And as a result, recently, there's been a whole bunch of dovish events that have occurred. First of all, you had the Fed hold. They didn't do any further tightening. Then maybe they had a little look into some other stats that I'll be talking about now. Then we had we did our live trading day on non-farm payrolls, because markets often take key direction off a big data number. And we saw payrolls was an undershoot for the first time it was the 15th month. You had 14 in a row overshoots above expectation. You know, the great Bidenomics was working a charm. Everybody, the red hot labor markets. We have our reservations about the authenticity of all of that with the birth-death model and everything else that goes into statistics. But the long and short of that is where there was an underperformance in labor markets. There also then was the CPI that came in low as well. So the CPI came in low and everybody suddenly started to see a fall off in the dollar. So roundabouts, and I think actually it's always best to talk this through to you almost with a chart in view, because then everyone can see it's happening and they can also spot the disorderly nature of it, Andy. But in essence, we went from a very hawkish Fed to quite a sudden, it's almost as I described, it's a bit like leagues and lags. You were accelerating really fast, and then someone hit the emergency brakes and you got thrown onto the bonnet there a little bit. So it was a bit of a cooling of the inflation is everything aspect with an undershoot. And today we got an undershoot on retail expectations as well, which was a 0.2 against 0.4 numbers and a 0.2 against 0.5 expected numbers. So everything in those stats has pointed to quite an abrupt slowing down. And one of the things that typically happens is markets is that they pre-price forward 6 months. It's a discounting mechanism for 6 months into the future. So let me just jump to that chart share and show you where we were and how it's gone, because that's going to add a bit of color to some of what I'm saying. So with a bit of luck, you'll be seeing the dollar index there.
Yep.
And I think I said last Friday, I meant the Friday before. Of course, it was the last Friday of the month. We're already mid-July already. So we've skipped on a little bit. The weeks are just hurtling by. But that was essentially the non-farm payroll numbers. And I'm going to, in fact, let me go a little bit further out. We're on the 4 hour. Let's take it to the daily just to give you this entire technical structure and how it's framed. So we actually love trading low volatility moments into expansive moves so that we can get super tight on that risk with a bit of leverage and have an explosive move away. That's to the downside and also to the upside. So you'll see that this was a squeeze of form on the dollar index. And what we tend to find is just before a major level, especially if it's going to be a headline grabber, like running 100, that's the 100 line on this blue line over here, and that's the 100 number, you tend to wind up and get a bit of momentum. So key levels are broken with momentum. And you'll see that from around, as I was describing the trading day, non-farm payrolls, that was over here, you could have got shorted around 103. Our last get short moment is that third low over there on the green line. And we have a projected target for 97 on the Dixie. And what's happened is this has been pretty abrupt, and disorderly is the word they don't like in the Fed, but a disorderly descent in the value of the dollar.
Okay, now, can I interrupt you just for a second? Because this is a key point. Are you saying that right before a big move, volatility is compressed, or are you saying that it expands and then it breaks through?
It compresses first, and the compression is the gift.
Got
So
it.
the gift is the compression because
That's
you
what it
get
shows in the chart.
100%. And you can see we sometimes refer to this even in our own lexicon as funneling. It's called the
Yeah.
HV method, the hunt volatility funnel. This is almost like guys who make protein shakes in the gym. You'll have a large male audience, I'm sure. Sorry for the ladies, but you have a funnel there for powder, putting your powder in your
Right.
plastic container.
And for
so
our listeners there, we're looking at the dollar chart here, and you see a very nice channel, but it's very tight.
Absolutely. And the compression leads to later high momentum moves. So the greater you compress price activity, when you get extremely low volatility, it's usually a precursor to a move. And actually, you've got a lot of equity traders in your audience pre-major earnings results. It's natural for volume and volatility to dry up.
Right.
Then you get a real repricing in. Now that's known fundamental event, but technical and fundamental, just two different sides of the same coin. And we get to see unheard of or unpriced in event data before it's made public. Chasing on the news is always meaning you're arriving late. So I was a news trader. I gave up. I was always selling, buying the highs and selling out on the pullbacks.
Me too.
Yeah, the key point is to be in there before everybody else is in there. And for that, you need to not know the narrative, but to trade the technical. You get the narrative afterwards. So it's almost like buying a book and not knowing the story you're getting, and then reading it afterwards after you've won the prize. And that's kind of our approach. So it's a little bit back to front. And this has given us a very strong sell-off. So I actually went Swiss franc and Norwegian kroner, got two shorts on the dollar on those two. But the euro's been pretty damn good as well on that front. And we're pausing. This is typical technical behavior when you run a key level. You first run it and then you muck about a little bit at that key level. You may even get a little bit of a pushback, but there hasn't been.
Let me interrupt you really quick. Why did we bounce right there? Or we didn't even really bounce, but why did we stop right there? If you can expand the chart.
Because key levels of significance, the 100 value, what tends to happen is a lot of people may have set targets at the 100. So people are round number orientated. Can I also point out derivative markets are all based on round numbers, even on equities. You get Apple $100, 110, 125, whatever. You're going to get the round numbers. No one's pricing 111.8. A call option.
Let me interrupt you about that. That is very, very significant, and I'm so glad that you trade that and pointed that out. I didn't notice that at first on the chart, but I see it there. I remember an old-time trader that I used to trade with. He used to trade specifically and almost exclusively round numbers because they act as a magnet for a market. Go ahead.
And we go a little bit further in terms of our HVF method rules. The round number is a magnet, and typically you should trade through them. They should be broken. So what typically happens is everybody doesn't get filled at 100 because there's a deluge of orders. So we talk about vacuums and voids in volume by price. So volume by price is a little known thing. Well, it's quite well known depending how engaged you are in the markets. But if you in fact pull a bit of data across, you get instead of the histograms at the bottom under the day, you get the histograms by price. So they're horizontal histograms. And what you tend to find is there are voids just before the big round numbers and just after them. In other words, there's not a lot of bid stack. Nobody prices to sell at 99.97. Most people go 100, and no one prices at 101.01. They just go 100 or 100.001, for example. So you tend to find that there's voids. Now, when the ladders have these vacuums and voids, these gaps, the market price behavior shoots very promptly through them. This is why you often find very significant levels are smashed through with quite high momentum, and then you get a pull back. So you clear the void area, and then you start to hit the stack, and then you've done a lot more move than people expected, and then you get a natural pullback. So this is
I look at it as the market. I'm sorry for interrupting, but I look at it as the market taking out all the stops, if you would, taking out the novices, if you would. That's why it goes through that either on the upside or on the downside.
A lot of people will say that because they're on the wrong side of the market. It does feel that way. When you're on the wrong side of the market, it feels that way. Once you understand what I'm saying, it's just price behavior doing what it does.
What it should
But
be doing.
because you were long when you should have been short, and you had a stop on the other side of the 100 level, and you thought, gee, it just did just enough to run that 100 level and take my order out. You where I was at in the early stages of my career, feeling unlucky. The minute you start positioning and understanding the concept of price behavior better, you start to feel a little luckier. You don't seem to be just shaken out at all these key points. And that tends to happen. And sometimes people get a bit conspiratorial. Listen, I'm right up there with conspiracy. Most things are rigged. There's a lot going on. But you also can't undermine yourself and let it be a license for not owning your own outcomes in the trade market. Oh, my broker stole from me. My broker stole from me. I get a little tired of that, and I train that out of traders. They're enablers. They're allowing you access to the market. They're taking risk of their own. If you've oversized, you could have had a deeper stop. If you were smaller in size, etc., etc. You have to understand the rules of game. It's almost like in the South African reference, you've got to play to the referee. This is a bit of a rugby one. Sometimes they have a bit of a bias. They're more strong on certain rules than others. You've got to be adaptable. So we've got to always own our own outcome. So I just stop people from allowing that one to manifest too much because it'll block their progress.
Yeah. So
anyway.
Let me know if you have more on this. Let's go ahead and talk about that. Or less. What does this mean again for general equities and specifically for our listeners? Natural resource stocks and gold and silver. How does it parlay that into that? What does this exactly mean for that?
So the great thing about a dollar going down is the following: is that it is taking a lot of fluff out of the market. So stock markets can stay up in diminishing dollars a little better. Resources do better. My personal favorite is going to be precious metals. And as we dig a little deeper, I will point to that because it is positioned as an anti-dollar. So we call gold the God market, and we refer to it as the anti-fiat king, and dollar as the fiat king. So you're actually putting two things up against each other. And when the one is systemically weak, and you're actually getting the tiptoe into the euro and the other likes of that, you're actually getting you will get an awakening gold market as well, because not everybody wants to stay in the fiat pool. Some will go, problem dollar, in we go gold, and you'll get a little bit of that seeping into Bitcoin as well and crypto. But there's a chronology. So it's like you looked at Lamborghini Diablo's bonnet, and you look at the firing order in the cylinders. First, you get this dollar weakness. Gold hasn't been spectacular. It's the doldrums. It's been like another currency. It's actually been softening against the euro and the pound, and I'll show you that. But last night, a seminal moment happened. Not only did it was gaining against a weak dollar, but it started to gain then against a weak pound and a euro. So this is awakening of the anti-fiat, because now it's becoming clear the dollar's losing a lot. Now it's a question about fiats as a whole, rather than just changing and rotating inside the fiat category. Let's all run into the euro. Well, they've got their problems too. In fact, on the euro, this is the first and very rare moment that occurs that you've actually got a higher. So here's a fundamental, a bit of the narrative, because people love narratives. I'm very technically driven, but I know that people love narratives. Right now, you've got a higher core inflation expectation in Europe than you have in the dollar, and that's rare. Remember, America is the consumption nation. Triffin's dilemma. You export the dollars and everybody sends you products. So you are net buyers and exporters of dollars as the nation state. That's the Triffin's dilemma. You have to proliferate and keep sending out your currency. So what ends up happening now is you're going to get a little bit of more attractiveness in the euro, because it's more likely they're going to be a little hawkish a little longer. So you have these huge treasury departments in big corporates. Think of Apple, that's making tons of profits everywhere, cash cow the world over. And they've got to decide now, what do they do with the iPhones they sold in Japan? What do they do with those yen? Are they converting them to dollars or euros? Well, they'll actually go to euros, because you'll have a treasury and a manager of the treasury department who will actually say, well, we're going to earn more interest coming because the euro land is going to hike more likely. Fed's gone flat. They're showing a softening. So the other key aspect is the dollar turns, Ernest, but it also, when it turns down, it's usually earlier. So there's a thinking that it'll be 4 months before Eurozone has clear slowing indicators to the same level that we've described with the USD. So that period of lag while you're waiting for euro, you actually get a dominant euro, which is a bearish dollar, because that's like a seesaw with a fulcrum. You're in one or the other. That's your 5 trillion currency market there, right there. You know, people aren't rushing to the Korean won out of the dollar. You know, they go to euros. The big corporates, they sit on big lots. It's liquidity. You can get fills. You're not getting slipped. You know the price. There's no nonsense in anything like that. They're not going into emergings and other things. That said, the pound is getting a little bit of a benefit. You're seeing 130 on the GBP and a lot of other things. So why is the currency market so interesting? Because it's going to also help the likes of precious metals, and it's going to also help the like of energies. And it can prolong for a while the highly expensive stock market, because actually you are taking a loss of value through your currency. You should view everything as a macro hedge fund manager. So here was our technical draw on the gold versus the dollar. And I'm going to just put an overlay scribble. This is what we call an inverted head and shoulder. So there's a left shoulder. We allow for what's known as a bit of a W head, which is a complex head, and there's a right shoulder, and that teal blue line is your neckline at 1930. So what have you done? You've already made that target now. You had a little bit of a pullback before the target, very typical, after breaching another key level over here for us, and you supported on it, and now you're breaking to the upside. And you made that inverted head and shoulder target. And remember, this is not just the target, but you will continue to reverse. So it's a secular turning after a dull summer so far. But I'm going to leave that draw on, and I'm going to show you that initially the gold wasn't that special. It was more about the dollar weakness. You see, I've left that on, and now this is gold versus the euro. And you can see that's not nearly as bullish. So interesting. So this was a dollar weakness event where gold was just in the mix like another currency. It's only now recently just started to get a better bid against the other currencies. Because if the dollar keeps losing dramatically, then people don't think, should I be getting into another currency? They think, should I be getting out of currencies entirely? Because this is a bigger crisis. The whole category gets battered eventually. And this is a turn on the euro. And that started last night, which is why it's so interesting that we're speaking today after grinding lower. And in case you think that was just a euro phenomenon, this is gold against the pound.
Look at that.
You can see it's properly popped recently. Whilst against, again, let me just remind you of the dollar. There's the dollar. And there's and there again is the pound. So you can see you reversed violently overnight last night. So
to all of our listeners over there
today.
To all of our listeners over there, we're looking at a chart with the euro, the dollar, and the pound, and we're looking at a breakout with gold and all of those currencies, which is very significant here. And it looks like you had some sort of compression, and then, as Francis said, and then an explosion higher. Very interesting.
Now, you've also got to remember a couple of other things that has benefited the US in terms of inflation. Many people will be thinking, we've won the war against inflation. You absolutely haven't. You've had the first stage. So when you got the 3% number, you were comparing it with a year ago, which was very high. So you have what's called basing effects. If I'm accelerating, and I'm going late into a curve of accelerating, I was already going fast a year ago. If I stop comparing when I only just started, when I was stationary, obviously the comparison slows down when I compare when I was running at my faster speed. It's difficult to be running that little bit faster. So you are 3% higher year on year on an already high number that had surged to 9 in the year before. So this is a basing effect. That doesn't mean you won the war. It means the rate of acceleration is slowing. But if I'm in my Porsche Turbo going down the Autobahn, going up to 300 Ks per hour, my rate of acceleration is quickest as I do the shift from first to second. It's not during the shift from fifth to sixth. Accelerating the most, but my speed is still climbing. So this is the important thing. It's a first derivative of speed, acceleration. So the year-on-year comparison is actually more a benchmark of acceleration of inflation. So you've slowed the acceleration of inflation. You haven't slowed the fact that prices are still getting more expensive, just at a rate of 3%, where before it was 9%. So they're still getting more expensive. Those things are still going up. This is repeated on the Australian dollar, by the way. You can go the whole shot. And in fact, we have a breakout against the Chinese yuan here for gold. So you actually got upside breakouts of that volatility nature that we described over here. I'll buy a bit more real estate and extend that. This is a breakout. We expect to see, this number won't mean anything unless you're in China, but it's going to be about 114,458 won. So this is another squeeze that's happening. So gold is now getting its groove on again, cross currencies, including a big producer currency for many of the things that you buy.
Got it.
Which is critical.
So really the question is that we're breaking out now, gold is breaking out now with all of the currencies. What is, and it looks like we're a little early. I did an interview with another guest probably 8 weeks ago, and we talked about the gold will more than likely move sideways, and in August, maybe mid to late August, we'll have our liftoff, if you would, or just the seasonality of it. And you were saying, and the charts are really saying, not specifically you, but the charts are saying that we're early here. We're breaking out early here. What would you say is, how long is this would last, or are we looking to explode higher? And what's your upside target now?
Yes, there's a lot in that to unpack. So first of all, the person who said that is usually right, that you tend to get a dull doldrums. But unfortunately, there's not much rest in the world during this summer because of the excesses. So there are a number of things that are slowly unwinding at a rapid rate, and it's going to force intervention and attention a lot sooner. So I think that's been brought a little bit forward. We have the gold and silver ratio over here, for example. That was a big sell-off. So you want this chart to go down as a gold and silver bull. We talk about this entire right shoulder here that's on a huge head and shoulder with that thick line. We call this a broadening structure. So typically these break down. When you've been coming down as you were into that and you have a broadening structure, you're getting more volatile. What tends to happen is you get a real slap in the face, as we call it, a strong sell-off. And then you get a final move setting up to break this lower basing ascending grind line. And when that breaks, we think you run for that neckline, which is 65 valuation on the gold silver ratio. So you're going to fall out of this 80s range that you've been stuck in. You've actually been quite range bound for a while, but you have been tightening. If you look at it over here, you've been quite range bound. And what starts to happen is these sell-offs get more brutal and you start to hang heavier. So again, you're getting compression.
Yep, that's exactly what's happening as we talk. You're getting
across
compression.
These highs like that. And that leads hard on you and you end up getting a strong down move. That's a right shoulder. That's a head and shoulder. And then we see that taking you all the way down to the 30s. So we see a 2,900 gold next leg target. That's not the end of the bull market, but a next leg. And we think that's starting to develop. And we see going with that 45-50 range for silver again, before it rests significantly again. So there's some real good action to come potentially. The key triggering event will be the break and let go of this grind line and the heading down to 65. And that will be disorderly. It'll come fast. So if you're not in it, you'll end up a chaser. Don't be a chaser. Cars, dogs chase cars. We're not dogs. And you want to stay out of that. Don't be a momentum chaser. So be early. So if we look at silver in of itself, there's a bit of a head and shoulder that we've been talking about over here. And we expect that $26 to be a triggering event. And that's your 45 and your 38 targets that are generated by that. So that head and shoulder to take you to around the 38 zone and a 45 run. That will correlate to gold being approximately 3,000 and roughly a 65 neckline valuation. So 65.
So as the precious metals run, are you playing the equities, the precious metals equities for leverage on these, or are you just playing the futures or the call options or the ETF?
So the thing with this, I'm going to take you back to the V12 Lamborghini engine and say firing order matters. The metals run first. Gold runs very first, as you've seen, then silver. The miners will follow later. So you have the opportunity to roll through them a little bit and get some benefit. The problem with miners is a lot of them forward sell and they have high energy costs.
Right.
So only when the market sees that they're going to have sustained periods of high value. Initially, the market goes, it's another spike. You know, you've got to be as patient as a nun or a monk in the precious metals market. People are bored of hearing big precious metals bull. So, you know, the miners are not going to start moving on the very first swallow of summer. They're going to need to see sustained high prices. They're going to need to see that on moderate energy levels, not getting too far away. And I think energies will go up slightly, but moderately, mainly on account of the dollar weakness. There is quite a lot of crushed demand. People aren't going to be booking flights for fancy European holidays. Their mortgage rates are higher. A lot of things are getting higher. So there's a crushed consumer in that. So the energy is not going to rebound as much. You've seen it come from the 67s back up to mid 70s. On oil, and in actual fact natural gas looks the best one for me now because it was really crushed. We'll show you a technical chart if you've got energy, guys, and you could pick up gas-based equities, but I would still look at the charts and want to see that the charts are starting to reflect what the actual commodity is doing, because where there's lags, you want to be first mover. Be where the first mover is. You can always roll into the laggards.
Yeah, pull up a chart on natural gas. I'm a big natural gas believer and trader, as well as oil specifically. So let's talk about it.
Awesome. So you've got a natural gas markets, friends. Let's get there we go. There's WTI, there's Natty.
Yeah, look at that. Fell out of bed. Yep.
And we do have good previous with natural gas, by the way. So, I mean, we've been trading, we were putting everyone long during these periods. You can see
we're looking at April 21. Yep.
Yeah, that was a great run up. And then we said to everyone early that this is going to be a short. And this was ironic because we were going into Europe and there was all the talk about possible lights out. I don't know if you recall that last winter.
I do. I was long actually, and I sold when that, and I mean this not as a stroke of genius. I just thought the market was way too frothy, and I liquidated all my natural gas holdings, but looking to jump back in. But anyways, go ahead.
Yeah, so part of what happened with that is that you got a big head and shoulder in there. In fact, you got a smaller head and shoulder. We call this a monarch head and shoulder. It's a baby inside on the head, which is the highest part. That triggered and that sold off, and that set up a right shoulder and gave you the bigger head and shoulder, and that triggered and made target. So I mean, we bearishly we nailed this, and bullishly we nailed this. So everybody got too into the commodity hyperinflation theme, and they overdid it. And the lights out over Europe. And what ended up happening is they bought an absolute unforgivable amount of coal from South Africa and everywhere else, and the lights never went out. They did a lot of dirty deeds while supposedly being green. And as a result, gas actually got shortchanged, and you had this huge sell-off. And this was violent.
It was.
People were pricing in. This was super violent. So the question now becomes, what now? Okay, you're so smart about what already happened. What about now? What's happening next? Well, we're starting to see, don't forget, you got a winter coming not too far off, and we're starting to see a bit of basing, and this is a falling wedge structure over here.
That's a beautiful chart too.
It's a beautiful chart for upside. It's coming off coming future upside. We would call that, again, right shoulder. You often end major bull and bear markets with head and shoulders. So I think you're in the process of completing a right shoulder. You might want to trade that falling wedge to the upside to the 2.9, and that 2.9 getting run is going to trigger you for north of 4. And that's a bit of a recovery. And then you go from there. Remember, again, major reversals don't just do the target, they are cyclical. So you saw this one's downside target took you to 2.9. You're at 10 at one point. We said 2.9s on gas, quite a big call, and you've ended up going to the twos. So you did overshoot the target, and I think you will overshoot to the upside with a coming winter again, because I know how hard Europe worked to make sure that they didn't run out of energy for last winter. And you can pull up trees one season, but I don't know if you can do it 2 seasons in a row. Emergency measure. So that is a reversal structure. So the possible entry is starting to look in and around the 2.6 zone. on a falling wedge here to move all the way up to 4. And you can have quite a tight stop. I'd put the stop under there, the lows, the technical lows there. And don't forget, you're going to have the weak dollar at your back that we've got all the way down to 97. So even when gas isn't being particularly substantially more demanded, you've got a devaluing currency inching you up.
Which is like, as you said, it's like the wind behind your back. It really is.
Absolutely.
So,
you get a bit of a tailwind.
let's talk about oil here, if you don't mind. Pull up a chart. You had a lot of news with oil. You had Saudis more or less going it alone about a month ago, cutting more. And then I watched the inventory reports, and you're looking at, you had a drawdown today, I want to say around 700,000 barrels. So what are the charts telling us, and with energy, with oil specifically?
It's a bit of a mixed bag for me. I think it's moderate hang time here. We did draw a head and shoulders at one point, and you can still see it there. In other words, consumer demand is being hard affected. That said, the dollar weakness is coming through so strong that it's actually rallied a little bit, the oil. You're getting a bit of compression. The volatility is low. You've traded in the same range for quite an extended period here and there. You've been bouncing between the 82 and the low 60s. That's a production cut gap, by the way, which then got closed. So that's not so bullish. Now they're talking more production cuts. Production cuts is price management. It's not overarching demand, which you can't. This is price management tools. So this tells you that demand is actually off. And the other thing we've done is that we do what's called 360-degree analysis. We'd actually divided that by the dollar index, because we saw an event of currency coming in where the dollar was going to become part of the story. So we were actually looking at this with the dollar index, and we're saying, what's it priced in general world currency unit, not just the dollar, because we saw the dollar becoming a little bit a part of this. And it's also still working its way up, but it's been hanging really, really heavily. And I think if you go something like the Euro USD, for example, it's already priced in dollars. So if you go divide Euro USD, that number is getting higher as the euro gets stronger. You can see how it flattens that. So in euros, that's your oil chart. You know, you don't want to get too bullish excited about that. The demand doesn't look brilliant. Hey, don't get me wrong, I'm a commodities guy. But when they are killing the economy to contain an inflation that they're not really containing, but they're getting lower numbers out because of basing effects, you are going to get some degree of reduced demand as well. That's
that makes a lot of sense. Totally. Yeah. And I remember trading the oil markets in 2007-ish when oil spiked about $1.40, and yet the economy was slowing down, and then everything collapsed. Not saying that that's what's happening now, but if you have a deflationary situation and economy slowing down, that's going to be very bullish metals. Correct me if I'm wrong. And it could be is the key word, deflationary, like oil, but even also industrial metals like copper, aluminum, that sort of thing. Correct me if I'm wrong.
Yeah, so a chart I like just on that topic that you mentioned is actually to do the cross-market analysis on gold and oil. I'm going to take it off log scale because, of course, we got a zero run there, and that really spoiled the chart somewhat. But if I just take you into this chart, this was a head and shoulders. It was the basis behind our gold long, oil short commodities trade, this setup here. So we stood on a stage in both November of 19. We'd also done many YouTubes from August 19 and also again in February at the Dollar Vigilante. And we said, trade oil down to single digits. And it hadn't been there in 35 years. And we said, by the way, to hedge your commodity, because I know you're all worried about inflation, go long gold. And you actually got the infinite trade because you actually had oil go to zero, which was unbelievable. We traded them separately and we shorted oil, and we shorted Carnival, a cruise liner, and a few others. We've done a whole case study of the whole collapse. That was essentially, we called the event known as COVID-19 without knowing what we were calling. That was the technical trade for the subsequent lockdowns and medical event, make of it what you will. But that was a collapse. And the problem you have is you had a little bit of a similar structure down here, bouncing along. Now, I'm not saying you're going to go COVID bad, but I think the demand is a little bit weak. I don't think it's going to get the same event at all, but I think there is definite loss of value to gold in oil. So the economic destruction is not going to see oil go up as much as the alternative currency value of gold will in an environment where dollar is going down. I don't know if that made sense, but
yes,
the one's going to get more respect in a falling dollar environment than the weakened demand will be able to do for oil.
Well, it does make a lot of sense. And for our listeners, think of gold as a currency, right? So gold being a currency with the dollar weakness, that's going to have the biggest benefit with the dollar rolling over and falling, as opposed to oil, or let's say also use this as an example of industrial metals, which has a utility aspect to it, correct?
Yes. And funny enough, we speak of industrial metals. We also gave everyone, if you like the precious metals complex, and I get the feeling your audience does have half an eye on that. We did, if you like the hedge concept. So many people are a bit scared of shorting an industrial metal or a copper or something like that. We put up a long platinum short palladium trade, which not only is it a commodity neutral trade, it's a precious metals industrial category. It's more tight than that long short trade. And within that, not only is it a precious metal industrial, because I mean, silver's industrial precious metals as well. It was platinum group. So palladium is within the platinum group. So you could have had a very tightly hedged trade on that. And platinum has been greatly disrespected. Many people, I'm of an old enough generation to know how platinum well exceeded gold as a price proxy. It was always more valuable. Let's be frank, in terms of if scarcity and rareness is the game, platinum is infinitely more rare than precious metal gold. And palladium industrially ate its dinner a little bit. And platinum got so crushed for such a long period. So I'm just bringing up another chart for you and palladium started to get used because of diesel engines. So they decided palladium could be used for it, and it was incredibly cheap. And what ended up happening is palladium climbed and climbed and climbed in value, and platinum just lost a large amount of its industrial reason. Now it's still a precious metal. So I'll share this chart. This is a long tailing loss of love for the platinum charts, and I think you'll love this one. Check it out.
Look at that.
In fact, I almost need to go to a monthly chart. Let me go monthly and squeeze it on there. So
look at that. That picture's worth 1,000 words, isn't it?
Of love. You're talking from 2009. This is so what is the chart you're looking at? First, let's be clear. Platinum divided by palladium. And if I just show you the peak at 2009, actually not that long ago, we may have been wearing younger men's clothes back then, but you're at about, I've got it in a percentage scale. Let me just get that in a log scale. No, let's go regular scale. That's a bit terrible. So you used to get 5.5 palladium ounces got you 1 platinum ounce. You needed 5.5 palladium ounces. Down here, 1 palladium ounce got, my apologies, you're only getting 0.3, which means 1 platinum ounce only gets you 1/3 of a palladium ounce.
Yeah, that's
so it completely flipped from palladium was only 20%, less than 20% of a platinum ounce, to virtually platinum becoming 29% of a palladium ounce. So it went from 5 times down, down, down. It crossed 1 to 1 over here, and then it's gone lower and lower and lower. And these are incredibly rare minerals, and they're also not the most stable countries that bring them out. My good old South Africa is in there, and Russia at the moment, as you know, the big platinum group metals. You don't get it, you don't dig the stuff up or find it at all easily. So this was a basing out period, and since then, if I just drop this to a slightly smaller time frame, that's monthly, just to show you the massive collapse in the relative valuations. We suggested to everyone to trade long on this falling wedge. In other words, you could go $100,000 long platinum and $100,000 short palladium. And that's how you would have done. So it's been kind of a bull market, pretty much with a couple of setbacks, but nothing too big all the way up. And you've gone from 0.4 to 3/4 of an ounce. So that's almost a doubling in your trade. So it's a very effective, it's been a very effective trade on that bottom. So platinum is coming back. It's still around $1,000, well below gold. That should be very soon at 2,000. So a lot of pent up demand. As I say, I'm trying to remember the ratio of platinum ounces to gold ounces. Someone in the comments will leave it to me. I need to get that fact. I don't want to hazard a guess, but it's double digits. You just don't find this stuff. You know, if you have 2 Olympic pools of gold, you've got a fragment of that in platinum.
Yeah. Real quick, comment a little bit about crypto and Bitcoin, as we're, again, the big story that you're communicating, and which I agree with, is this recent dollar weakness that is, and it's accelerating, it seems like. How is that affecting the cryptocurrency market, specifically Bitcoin and Ethereum?
Yes, well, there's more to the currency markets than just Bitcoin and Ethereum. And in actual fact, the most recent info that we put a lot of people into was actually on XRP. So I will show you that. It's a status token. So people will go, boo. It's definitely going to play some role, I suspect, in the central bank digital tokens in terms of the rails. So this is your big, your anti-freedom money that our central planners have for us. So it's a pragmatist trade. Make the money, buy yourself some freedom, because it's coming whether you like it or not. It's what I call a hold your nose trade. It's a bit like buying the military industrial complex. You don't feel good about it. There'll be some people that'll take moral positions on that. I tend to say you don't control what goes up or down.
We're trading charts.
If you can build wealth and use it in the right way, you have to be in the matrix to pull down the matrix. So if something's going to go up, I'd rather be in it and benefiting from that. But I recognize there'll be some people that will make moral arguments. So this is Bitcoin, and in the similar way, it's quite a busy chart. So I'll just switch off all the lights there so I don't scare everybody. Bitcoin has been stuck in a range on the dollar between the 29.9/30 level to the 31 level. So you've been in a stall box there. You're on the low end of that now. But that's actually what I've called a slow motion hidden correction, because, of course, the dollar's been going down. And this is why we do, again, that currency analysis. That's Bitcoin euro. You can see it's been correcting from that. That's Bitcoin pound. Similar thing. You can even go Bitcoin yen. Wow. You've actually got a falling wedge type structure. It's been in a pullback that's hardly been noticed. So this is Bitcoin yen, and how I'd carve that chart up is I'd say, there you go, falling wedge. There's going to be a surge coming soon to the upside. So with the dollar continuing to lose value and getting disorderly, that's going to lead to such a push in the tailwind that even those things that have been correcting, of which gold was one, but has now shown that it's turned, Bitcoin was actually the other. Most of these things were showing us that they actually were quite okay with hibernating for the summer and coming alive with the autumn and the fall, as you call it, up stateside. But what's ended up happening is all the bears have been woken up and said, come out from under your snow. It's already spring and summer. You should be out and about and charging. So all animals are being, brought out. And this is dollar driven. So we're going to have a long bull market surge, I think, to come out of this. It's already corrected. It had its push up. This was the trade that many of your viewers would have loved to have been in. We had a whole bunch of our community very strongly in, and that was XRP. Again, the key low risk, high reward trade, which was right here. Whoops, that's a little bit of a small line. Let me just correct for that.
Look at that. Wow. So
we were trading this fella and we got the luck. I didn't even realize actually that there was a decision pending. This court case with Ripple has been going on and on and on, and trying to keep up with who's doing what. So I always find that the narrative suddenly catches up and you find out why later. We've got such a beautiful break. We looked at all these hammers there, and this is all part of a far bigger move we expect to see. And this is what I call the fractal within fractal. So that was a huge move. Guys made 6 and 7 digits there. We got some new minted 7-digit liquid guys that were really as happy as clams that we were all over this. We've been talking about it on our Crypto Sniper, channel for quite some time. So we separate, crypto is the divisive topic for some people, especially the older guys with traditional markets. They don't want to hear about these things sometimes, but I can tell you it's coming. And this right here is a target of $17, $16.77. And we entered on that and we're now long. We've also got investment in that, but that is a 683 risk reward trade. That is the value of trading one small fractal to break into a far bigger move. The far bigger move is this one that I was highlighting here. Whoops, let's get that line drawn again. There we go. There she comes.
Yep.
That whole bigger squeeze. So that's given us a massive move. If that continues without running that stop, if it doesn't come back down and run that stop, it continues in that direction and eventually runs the 16.77. It won't be overnight. Things don't go up in straight lines. We're expecting a tap out through $1.11, $1.12, and a little bit of a rest and a pullback before it goes again. This is going to be huge for Ripple, because essentially you've got to reinflate an entire financial system, new railways for a system, and you're going to be deflating the old, and you need enough of a balloon that can be filled to take all the amount of monetary transactions that you and I and everyone else on the planet does. So you've got to take a beach ball and turn it into Jupiter, basically. And some of these moves are some of the great opportunities that will be presented. And this is what we're all about. How low can I get my risk, and how expansive can I get my reward? And can we get patterns within patterns, multiplying instead of trade by trade, adding your way to wealth? Multiplying your way to wealth involves using the stops of smaller setups like this one to break into longer term, bigger setup structures. So this is going to be, if it turns out the way we hope, it's on balance of probabilities. We're talking about the future, potentially very bullish for XRP. I think the overall crypto market will be going up, and its sister token Lumen will do just fine as well as a rival in that space as well. So there's a couple of really big whole shot. We actually have a mystery token that's in our community that I can't discuss. 70x is our expectation, with real geometry, with real method, that we think has a chance of doing exactly that, and is not one of these small penny, little bit dodgy coins. It's in the top 15 of tokens, and has shown real strong relative strength. So a little bit of delight to come, and the dollar loss of value is going to drive gold. It's going to then drive silver, which will overperform gold once that starts to happen in that chronology events. Bitcoin will then get a surge, and then some of these selected alts for their roles in the future metaverse and surveillance finance system that we're going to stumble into, they are going to have to become the Apples, the Googles, etc., of the technological money system. And I treat this as my last freedom moment to really kill it in a bull market, to buy myself some freedom in this cage that is being lowered down over us. Let's have some morbid sense of humor about it. Let's keep it, I don't want to depress anybody. If you're going to be a slave, be a rich one.
I got it. Well, Francis, I want to thank you so much for your time. I love that you started with some great visuals for our listeners there, but also that you really did marry a lot of fundamentals with this, but you won't trade something unless the charts give you your indicators give you the go ahead, whether it's to the upside or to the downside. For our listeners up there, the first thing that I really, really loved about our discussion is that this is really set up, all of this is really set up with dollar weakness. And then the second, and that was your last point, this is what I really liked, was that you're entering into low risk trades. It's all about controlling your risk. So I couldn't agree more with that. Francis, tell us how our listeners can get in touch with you if they want a part of the Market Sniper or even access to your fund.
Yeah, we specialize doing one thing really well. We want to be wealth builders in reset times. All these trade ideas are going to benefit immensely. Natural gas, the tokens we just mentioned at the end, they're precious metals from the collapse in the dollar to the downside. But the actual technique and how you're doing it, keeping risks super tight. Everything we do must answer. What point are we entering? How far away is that stop for money management? Is it sized? And what's the juice that we get in terms of reward? And at what point do we take off? So many people in crypto have round tripped into quite a high value and back down to zero and actually worse off than before. And even people in penny stocks and precious metals potentially too. There is a point to take off. You need a methodology and process. We specialize in that. And we also specialize in these exceptional reset macroeconomic times, which are abnormal, where traditional advice will get you into deeper trouble. We've all removed debt as investment instruments from our wealth, and we've all removed debt as things that we pay in lieu of the potential danger in interest rate spike situations. One of my next predictions is once the dollar's had a major disorderly loss of value, the Fed will come out swinging, and you could get very extreme rate hikes to defend the dollar that could eventually lead to a rate spike, a spike in the dollar as well. So as weak as we are to the downside, they're adding this volatility, and it's going to do damage in both directions. And you need to be protected from that. Having too much debt is going to hurt you. You can engage with us from the marketsniper.com website, book a call, have a chat with the friends. We have a well supported by the North American market, Canada, and the States. You can also just follow us on YouTube at The Market Sniper for traditional markets, and very active at the moment on crypto, because there's been some great gains made there with events, including that of the SEC. In short, you see in the chart the news before the news, you get the reason later. You've got to trust the footprints in the sand. The charts are the footprints in the sand. Thanks so much for having me on, and I look forward to all your viewers connecting with us.
Absolutely, and I'll put all of this in the show notes below this video. Thank you again so much.
Absolute pleasure. Bye for now.
Yep. Bye.